But Kunal is here in the studios. Let's ask him about what this Monday morning and this week could look like. Kunal, hi, good morning. Seems like some of the good work from last week is going to get undone today once again.
Yeah, I think maybe like a replica of what happened on Wednesday, but not exactly on the same magnitude, but a very minor magnitude because I think looking at the way markets are poised, it's just I think we're trying to define a range over here for the index, and 24,000 seems to be a point where the markets are just about trying to absorb every kind of volatility. It's just that our markets are not as sharply correcting as compared to many of the other Asian markets, which are going through a very sharp phase of correction. So I think that's the only positives which you can take out for the last 2 days. Thursday and Friday, we saw the net market breadth to be very, very strong and positive. It was just as if the markets had forgotten what had happened or transpired on Wednesday. It was good to see many of the stocks as well as sectors making a strong comeback, and the usual theme that the mid caps and small caps continue to outperform. So we are, I think, in that environment where the benchmark indices are probably going through a phase of lull. If you look at this in a range of 500 points plus minus 24,000 mark, but the action is specifically towards individual sectors and the mid caps and small caps.
If you look at the kind of positioning which has come into the options, 24,000 acts as a good support. But today we are at risk of breaching 24,000 as well, given how the Nifty is trading at this point in time. What is the next support if it breaches 24,000?
So see, even on Wednesday, for example, we moved towards 23,800 mark on the benchmark indices broadly, and on the upside, 24,200, 300 seems to be a strike where the markets are seeing a lot of call writing. So I think we are stuck into this now 400 odd point band, 400 and 500 point band for the index at those levels. 24,200 to 300 remains to be a resistance on the higher side, but on the supports, 23,800 I think should be a decent short-term support. I'm talking of it specifically from the weekly expiry perspective.
Kunal, what is the sectoral flavor likely to be for the large caps specifically, and whether the strength of the broader market will remain intact while large caps may cool off?
So I think, yes, largely the broader markets should continue to outperform. Large cap wise also, I think we've been to a very fine tilt on the large cap names because, it's a variety of sectors, the private sector banking names making a comeback, large cap real estate stocks making a comeback, NBFC stroke HFC names, these stocks have done very well for themselves on the large cap front. So there are those individual odd sectors and stocks which have done reasonably well, except of course for those 2-3 major large cap names, heavyweighted stocks which have not moved much. Not just Reliance and HDFC Bank broadly in the last couple of days, but even L&T I think has been now struggling to hold on to that 4,000 levels. So I think there are those 3-4 large cap stocks which is acting as a weightage for the Nifty or acting as a drag for the index to try and lift off and provide any kind of a breakout or breakdown. But I think the mid caps and small caps are doing well. I was looking at the point where the sector performance and real estate has been one of the most best performing sectors in the last 3-4 months. And I sense that now there could be a point where you might see some bit of profit booking over there because there seems to be a very heavy amount of open interest built up and delivery-based volume which has already happened to this space. So maybe I think you might see some bit of a churn which could happen with respect to those sectors which have performed very well erstwhile and the ones which could probably go into a series of outperformance.
Now, two stocks that stood out on Friday was Kalyan and Dixon. Both of them saw high volumes but low delivery, which is there. How do you look at those two stocks?
In fact, I was actually studying Kalyan Jewellers quite extensively this week, and I was looking at that whether this was more of a speculative move led by short covering. Apparently, it was not at all short covering. The data started off from 6th of July towards the last week Friday, and the net open interest broadly in the last 4 or 5 days of this move for Kalyan Jewellers remained at 3,26,29,000 contracts for the stock. So maybe plus minus 2,000 contracts. It's a very small amount as compared to the quantum of open interest which was built up. But the actual jump which had happened for the stock was on delivery-based data in terms of volume, the quantum of it. So it started off with say 5 lakhs as a net delivery volumes, moved towards I think 1 crore plus as a delivery volume for the stock price. So that tells you there's been an exponential jump on the cash basis buying which has happened for the stock. Now historically we've seen that whenever stocks move on high delivery volumes relative to the short covering in futures, they are strong sustainable moves. And whenever these stocks go into a correction, there are a lot many buyers who are ready to buy the stock at a corrective wave. So specifically on Kalyan Jewellers, I would sense after this 4 or 5 days up move, just wait for a mild bit of a pullback or a moderate zone for the stock. if it comes, say, closer to 420, 430 kind of a mark, I would sense that there should be good amount of strong delivery-based buyers which can support the stock back again.
And Dixon?
Dixon, I think, on the other hand, I did not study it extensively, but the stock managed to, I think, cross back above the 200 moving average previous week. That was a supporting factor for Dixon because earlier the stock, I think, last time when it had fallen below the 200 moving average was in September, October 2025. So after a gap of almost like 8-9 months is where the stock has managed to confirm a breakout. This looks to be a stable chart in the making right now for Dixon Tech, but I would still sense that there could be more like a rally, a correction, and then a pullback and a movement again.
Okay. Picks therefore in a market like this, Kunal?
So concentrating on few large cap names, but the ones which are slightly low beta, BEL is something which I would recommend as a buy at the current levels. The stock apparently, many of the defense stocks started to look a little bit more attractive from Thursday, Friday trading session. So expecting BEL to start to come back into its own zone of outperformance. 434 as a target, stop us at 402. And the second would be SBI Life. Now this could be also an interesting stock. We've actually seen a good amount of buying which has happened for the insurance names over the short term. So we'll look at a buy in SBI Life with a target of 1900, stop us at 1825.
Before we move forward, just want to map what the Nifty as well as crude have done, because largely one would assume that it's an inverse correlation that you've seen in the way the crude cool-off transpired from those March 28 lows and the way the Nifty moved, if that dual chart can just come up for you on your screens. But Kunal, would you establish that kind of correlation, or rather inverse correlation, as I should see, as you can see on your screens, with the Nifty and the way the crude prices have moved?
Yeah, absolutely. I think this correlation does, inverse correlation does exist, and that's also one of the major prominent reasons why our markets tend to be a little bit more sensitive towards the movement on crude oil prices, and especially those, high sensitive moves on the upside or on the downside. Largely, I think for a good part of 2025, we were trading in a band of $65 to $75 for Brent crude, so that did not affect the market sensitivity as such. But start of this year, when crude oil prices start to spike from those $70, $75 per barrel, I think from there, our markets have actually gone to back again that higher correlation or an inverse correlation to speak so. So I believe that yes, this inverse correlation does matter a lot. And in phases where the markets are wanting some sort of a data point or asset class to be more like correlated or anti-correlated, that's the time when crude generally plays a very strong effect.
Okay, here's fingers crossed that you don't see much of an escalation in crude, because like we saw play out on Wednesday, it seems like there is a direct move on the Nifty with the way the crude prices move. But a lot of other stocks as well, which are going to be in focus. Look out for what OMCs may do, given that Brent crude is now nudging that $80 per barrel mark once again. And mind you, it's an uptick of a solid 4% that you've seen. So let's hope for some stability for crude prices. If not, look out for way these OMCs, etc., and the oil sensitives may actually pan out, the likes of paints, etc. as well. And then yes, today Idea Forge is going to be the big one to look out for. It's a 500 crore rupee QIP that they've closed at 795 rupees per share. But other than that, of course, and there are many other stocks that we'll talk about in the due course of the show. There's Avenue Supermart, which came out with its numbers largely in line, and there's LTM as well.
Well, yes. In fact, when you're looking at Avenue's numbers, they looked, fairly soft in that sense. You had just about in line in terms of all of the numbers. 5%, 5.5% SSSG was probably the lowest in over 5 quarters that we saw. And that led to a bit of softness as well. But margins, though, held up decently okay in comparison to that SSSG. The SSSG not translating is obviously negative on margins, and therefore that margin hold up looks decent. 8.2% is where the margin was expected in at, came in at 8.3%. So fairly okay over there. And that was largely led by apparel. Really, that's where the margins or the gross margins actually built or came in far better than what was expected. So the gross margin was what led to the kind of positivity on margins. So that's how Avenue really shaped up. Where LTIMindtree is concerned, Sajid, I'll come to you because you track IT more closely. I mean, the numbers again on the top line was soft. Middle East exposure actually keeping that execution on the top line softer than what was anticipated or penciled in. but margins were fairly resilient, right? 15.5% was a better than expected margin number.
Yeah, I mean, there's a 40 bips bump up in margins to 15.5% for LTM. But from a top line point of view, the revenue up 2.8% on a quarter-to-quarter basis is 0.1% on a rupee term, which is there. But on a CC term, 0.3% quarter-on-quarter. So the numbers pretty much looked in line for me. But from on a base like which LTIMindtree is there, it's much muted from in that sense. So it's, if you look at the annualized revenues of coming from AI, it's around $600 million, which is there. They got $1.7 billion of order book, which was there. But there are certain challenges which they are facing. North America is resilient, but Europe is lagging behind in growth. And then you have the headcount was marginally positive, but discretionary expense is not coming through. So it's in line, but I would say it's more tilted towards it's not as great number.
Right.
But 4% on both, on two counts, and really that's the other number that really stood out, viewers. 4% on BFSI and 4% on high tech. Both of those verticals doing well, and mind you, BFSI has done well even for TCS, so that's a vertical you want to keep your eye out on. Broadly, that's how it's shaping up really for IT this earnings season. Of course, HCL Tech will also come out with numbers. We'll slip into a short break, come back, give you a view of or a glimpse of HCL Tech's earnings, what to expect on the other side.